First off, we appreciate you guys being here today. We know this is an exciting, lively topic. We'll try and make it as much so as we can, but it's certainly an impactful topic. My name is Jerry Moss, and my tax partners, David Lister and Mark Patterson, will be kind of tag teaming this throughout the next hour and a half or so. So, what are we here to talk about? The Tax Cut and Jobs Act of 2017. And kind of some of the major pieces of that, we've got them broken down into corporate and businesses, pass-through entities, which is probably the most exciting part of this program. We saved that for David. And then Mark will pick up on the international, individual, estates, and benefit plan section of the program. So that's kind of how it's laid out for us today. And again, don't hesitate to ask questions when you've got them. So corporations and businesses. So the corporate stuff is stuff, I mean, I'm the dumb guy in the room, so they gave me the simplest things to talk about. The corporate tax rate is 21%. Check, right? We all got that. That's down from what was the maximum rate of 35% in graduated brackets to get there historically. There used to be separate rates or the flat maximum rate for personal services corporation. Now the 21% is applicable to a personal service corp or any other corp for that matter. This is, and some of these first provisions are permanent as tax law can be. As we move through this, we'll try and make note of many of them that are temporary or have pre-designated sunset times. And then lastly, on the corporate tax rate, the dividends received deduction. So corporations get a deduction when they receive a dividend from another corporation, depending on how much of the stock of the other corporation they own. And to make that kind of bring the parity to that with the reduction in tax rate, they've also reduced the dividend received deduction from 80% to 65% or 70% to 50%. The corporate AMT, alternative minimum tax, is kind of a mystery to most people. The mystery is gone for corporations. It's still in play for individuals, but I won't steal their thunder on that for later in the show. As the AMT goes away, you know, when corporations pay alternative minimum tax, they get that captured as a credit that can be used to offset future regular taxable income. So at least they incorporated a provision to allow you still to get the benefit of that AMT credit, even though you won't pay alternative minimum tax anymore. And it's a little, you know, it can offset regular tax liability, and then after this point in time, it even becomes refundable, which it has not been historically. And it's partially refundable for a few years, and then it's completely refundable so that you would reap the benefit of it fully by 2021. The next several slides I'll sum up as kind of accounting method stuff. And that's whether it's a cash method of accounting or how you account for inventories and things like that. And they've raised the income levels for eligibility for either for preferential accounting methods like the cash method versus accrual accounting, raised that threshold from $5 million to $25 million. Accounting for inventories, raised it from what was $10 million to $25 million now. Uniform capitalization rules are rules that are special for tax purposes where you have to capitalize indirect costs into inventory and defer those deductions. So there's kind of a magic threshold. You'll see the theme here is $25 million. It's kind of the break point now for a lot of this stuff for corporations. So if you're under $25 million average gross receipts, then you don't have to do this uniform capitalization stuff anymore, which is kind of it's just a separate calculation that has to go into your tax return, and it's kind of a relief of a big burden. It's a timing issue for tax purposes that defers deductions, but a lot of people will be better off in a simplified world of not having to do that if they fall under that $25 million. Construction companies. Do we have any contractors in the room? Welcome. Thanks for being here, as with everybody else. So this is another area where they raised the threshold. 10 million historically has been a magic number for contractors. Below that threshold, contractors are eligible for some preferential accounting methods, completed contract. They're not required to do percentage of completion accounting for tax purposes, which usually results in deferring income. So they raised that threshold from $10 million to $25 million. So this next section really is aimed at depreciation. Bonus depreciation, which hopefully a lot of people have heard of, is where you can take additional first-year depreciation. It's historically always been aimed at newly manufactured property. It's the first time ever that used property is included and is eligible for this. And it's historically, in recent years, been 50% bonus depreciation. In other words, if you paid $100,000 for a piece of heavy equipment, you could expense 50% of that in year one under bonus depreciation previously. Now you can expense 100% of that. And the effective date for this one is September 27th, 2017. That's about the time that this whole Tax Act started getting going. So I think that's what that date's tied to. This is a very temporary provision of the new law that starts phasing out in 2023, 20% a year, till it's gone completely as it currently stands in 2026. Section 179 is a similar provision that allows for expensing of asset additions in the year of acquisition. This is a little more limited, a little more restrictive in how it operates, but the threshold, big picture, the threshold was raised from $510,000 to $1 million inflation adjusted. This particular provision phases out after you acquire X dollars of assets, and that phase out threshold has increased from $2 million to $2.5 million adjusted for inflation. So another thing that's important to point out, I think, in distinguishing between these two provisions, bonus depreciation in Section 179, is how Tennessee treats those deductions. So Tennessee follows the federal law for Section 179. If you take Section 179 and expense acquisitions in the year acquired, then you can do the same on your Tennessee franchise excise tax return. For bonus depreciation, we're forced usually to keep a separate set of records for depreciation for Tennessee purposes because they don't allow bonus depreciation. So there's oftentimes 3 or 4 parallel calculations of bonus of depreciation for federal purposes, alternative minimum tax, not so much anymore for corporations, as well as state level depreciation. Depreciation on autos, they raised the limits on business autos. There has been pretty restrictive in the past, so just the first year, won't read all this to you, but the first year historically would have been limited to $3,160. Now that's up to $10,000 in year one. These numbers are indicative of a vehicle used 100% for business purposes. Depreciation for real estate. This is a pretty key piece of the provision. It provides for a new term in tax law that is called qualified improvement property, and that's an improvement to an interior portion of a building that's a commercial building, a non-residential real property, that's aka commercial. The improvement has to have been placed in service after the initial building. So it can't be an initial construction, but after that, if you have something that fits in this bucket, it's depreciable over 15 years rather than the commercial property historically would be a 39-year depreciable life. And we'll talk a little more about that here. So there's, again, I've mentioned the parallel depreciation systems we have to deal with in our world. There's regular tax and alternative minimum tax. So this slide talks about some new lies that have been put in place for alternative minimum tax, really. And it's different depending on whether you have qualified improvement property or just general residential property. And the key to these lies and why that's important is and we'll talk about this a little more later, but there's a new provision that limits business interest expense. And for qualified real property trades or businesses to elect out of this interest expense limitation regime, the cost of electing out of that is taking slower depreciation under these ADS lies. We'll hit a couple of other items here that still kind of fall under the depreciation amortization category. Self-created property historically has been treated as a capital asset, resulting in a capital gain when sold. That was changed to be ordinary income, but for an election that was retained to treat musical works as a capital asset. Research and experimental expenditures, this is a rather minor change as far as I'm concerned, but previously you had choices about what to do with research and experimental expenses. You could deduct them or amortize them, and now it's just made that clear that they're amortizable over a 5-year period.
And one good thing that the law did keep is the research and development credit that you can take. There was talks at some point about doing something a little bit different with that, but I think with wanting to spur innovation here in the country, they wanted to go ahead and keep the R&D credit. They're just changing how you deduct the expenses now.
So like-kind exchanges is another area that thankfully they didn't change the eligibility of real estate for this benefit, but for folks that might trade in equipment, contractors with heavy equipment, aircraft, things are frequently traded. When you get rid of one and you're going to buy another one, it has made all the sense in the world to trade it in and defer any gain that you might otherwise have to recognize. So they eliminated the ability to do that with everything other than real property. So equipment, aircraft, things like that are no longer eligible, just real property.
Probably the one we see most is automobiles.
Right. So this is a biggie. There's a new limitation on deductibility of business interest. Never existed in the past in our world. Historically, if you incur interest in the active conduct of a trade or business, it's ordinary tax deduction against your income from whatever business you're doing. So this new law has put in place a limitation on the deductibility of interest expense, and the limitation is that it can't exceed the sum of your interest income, 30% of your adjusted taxable income, or if you're a dealership, a car dealership, or anything of the sort that has floor plan financing, that can be added in too, and that's kind of the limitation on business interest expense. And so this is the limitation that a few minutes ago I mentioned, electing out of the regular tax depreciation lies to slower alternative minimum tax lies for the sake of avoiding this interest expense limitation for certain real property businesses. So just a couple of more points on this business interest. So if you have gross receipts of less than $25 million, you're exempted from this limitation. If you get stuck under this limitation and have interest that's disallowed, it's carried forward indefinitely. It's not forever lost, though most interest is at most businesses that are living and off of debt and incurring interest as a result. I mean, absent a pretty significant change in the capital structure, I mean, I don't envision a business 1 year being limited by these rules and the next year freeing up. So it's probably something you'd have to really change your capital structure to work your way out of.
And when you talk about the adjusted business income, you kind of take your income before any changes, you add back your interest. For the first 4 years, you add back taxes, depreciation, and amortization. So you kind of start with an EBITDA number that you apply that 30% limitation to. After 4 years, it changes to an EBIT number, so you don't get to add back depreciation and amortization. So you'll be starting with a smaller number to apply that 30% limitation to.
So another example of how this impacts Tennessee companies is a lot of Tennessee operating businesses are of the approach where they may pay bonuses out to owners at year end to manage their taxable income for the Tennessee excise tax purposes. Well, if you do that and you have, let's just say, zero taxable income, well, 30% of zero is zero, and you're not going to get any interest expense deduction. So there's some planning that needs to happen there over the next several months. A lot of the things we talked about so far have been beneficial things. This is a takeaway. They took away the domestic production deduction, which was basically a deduction for equal to 9% of qualifying income generally for manufacturers and construction industry, if it was manufactured, produced, grown, or extracted, I think is the terminology that of folks who typically would be eligible for this deduction historically. That has been repealed. Net operating losses, for a long time, the rules for net operating losses have been that you carry them back 2 years and forward 20. And that's really helpful for companies that kind of are volatile and they have a loss, a profit in year one, and they'll say smaller profit in year two, and in year three they have a significant loss. Well, historically, you'd be able to take that loss and carry it back 2 years to the year you had income and get a pretty immediate refund back, which helps in those lean times when you incurred the loss. So the new rule is that the carry-back period has been eliminated. You can carry losses forward indefinitely, and as you carry them forward, it's only eligible to offset 80% of taxable income in those years. That applies to losses not for the calendar year just ended, but starting after 12/31/2017. This is another big one that is a lot of people are going to be affected by, may not have been talked about a lot. It's a takeaway. It's something that's going to probably change how you account for business entertainment cost. But in short, they've disallowed the deduction for business entertainment. And taking a little deeper dive on that, we've listed some of the things up here that are excluded or non-deductible now. Then they have been country club dues, golf athletic clubs, entertainment, amusement, recreation. And the next slide will have some exceptions to this, but the general rule is that entertainment expenses now are non-deductible. So the exceptions, and I sum this up as the first couple of slides, or 2 or 3, are mainly aimed at employees. So recreational expenses for employees, it doesn't say customers, doesn't say prospects, it's employees. There's a specific code provision that seems to have survived to allow for these things for employees, employee stockholder business meetings, chamber of commerce type stuff, professional organizations, and civic organizations have been spared of this disallowed deduction for entertainment. Business meals, generally the 50% limitation that has been in place for some time survived. So business meals, food and beverage, still limited to 50% deductibility. Something that's going to impact us fairly significantly is meals on the premises, on the employer's premises for the convenience of the employer, aka meals brought in during tax season to get tax accountants back to work. that has always been 100% deductible. So now, for a brief period of time, that's going to be subject to the 50% limitation. After that, it becomes non-deductible, and kind of the same rules and time frame on employer operating eating facilities. This is just a minor change, and it really clarifies some exceptions. I mean, fines and penalties generally are not deductible. And I guess the second bullet point down in the bottom says there's an exception for basically for restitution remediation, court-ordered restitution remediation type payments. Sexual harassment, any fees, settlement payments, et cetera, associated with that that's subject to a non-disclosure agreement are non-deductible. This slide is a neat little benefit. It's only for a couple of year window, but during that time, employers are eligible to claim a credit for payments made to folks out on FMLA, Family Medical Leave Act leave. The credit's 12.5% of the wages if you qualify, and to qualify in the finer print as you move down the page, you have to allow all qualifying full-time employees at least 2 weeks of paid leave, and part-time employees have to get a pro rata share of that, and the pay rate has to be at least 50% of normal wages. The more you pay these folks, the bigger the credit can be. It can range from 12.5% to 25% of the comp they're paid while they're out. So if you pay more than 50% of their regular wage rate, you can kind of earn up, if you will, into the credit. And it's time for a handoff here.
So who else heard of this 20% pass-through deduction? All right, and who else still has questions? Keep the hands up. Yep, that's kind of what we noticed. So the caveat to this whole section is the caveat is the AICPA came in and said, we still had a lot of questions too, and we're going to ask you, Mr. IRS, to answer them for us sooner rather than later. So as we go through this, speak up, ask questions. This is kind of the topic that everyone's really heard a lot about and has a lot of questions about. So this slide, I think, does a really good job of summarizing what this is all about. So there's two sides of it. If you're in general business, and if you're in, I'm going to refer to it as bad business, specified service trader business. We can define that later, but accountants, lawyers, healthcare, we're all in the bad business. I know. We all already knew that, though. So the general business is everyone else. And then you start down at the bottom on the general business side and on the specified service side. If you make less than $315 as a married or half of that as a single, no other limits apply. There's some hurdles you got to jump through once you get over the $315. So once you're over the $315, you've got, as a general business, a wage and property limitation that you've got to look at. And it starts to phase in, and it fully phases in once you get to this $100,000 increase of income of $415. So the wage and property mechanics of this are you take the lower of 20% of your income from these pass-through businesses, or the lower of 50% of your wages paid, or 2.5% of your tangible property. Easy, right? If you're in the specified service trader business, you start phasing out with this 20% deduction at $315, fully phased out at $415. So what's a pass-through? S-corps, LLC, single-member LLC, sole proprietors, they're all considered pass-throughs in this regard. 20% deduction for these people that are pass-throughs. So effectively, if you're in the highest tax bracket of 37% and you have pass-through income that applies for this, your 37% tax on your qualified business income gets knocked down to about 29.6%. So it's a 80% rate change there, or you're paying 80% of the highest rate. So the mechanics of it, it reduces taxable income, not AGI. You don't have to itemize. A lot of people, you hear deduction and you start to wonder, well, is this part of the Schedule A itemized deductions like charity? No. We don't really know how it's going to get onto the form. We suspect that if you're familiar with the 1040, it would be second page. You flip it over, it's kind of like a personal exemption or a deduction like that. This cannot exceed your taxpayer's taxable income for the year. It doesn't reduce self-employment income. It's just reducing your ordinary income tax. And we talked earlier about AMT for corps. For individuals, alternative minimum tax AMT is still in play, but this is a deduction for both. So income qualifying for this deduction includes any income related to proprietors, partners, S-corp shareholders, qualified REIT dividends, and income from a publicly traded partnership. It doesn't include any amount that an S-corp pays out to their shareholder as a wage. So if you're used to, in Tennessee, we talked about it earlier, you pay out your earnings for the year through comp to manage your excise tax. In this scenario, that comp doesn't qualify for this 20% deduction, and you're left with no pass-through income, and that would limit your deduction to zero for it. Guaranteed payments work in the same way, so any guaranteed payments that you get as a member or partner in a partnership wouldn't be eligible for the 20%.
So same as, the interest expense deduction, managing your income of an S corporation or guaranteed payments out of a partnership, we're going to kind of have to take a look at this a little bit differently, especially for businesses in Tennessee, because obviously if we want to get the rate reduction, that 20% deduction, we have to let the entities have some income, which a lot of times we have historically tried to limit that income to not pay the Tennessee excise tax. So I think through both of those changes, we're going to have to take a hard look as far as what a strategy is for going ahead and managing the income of these flow-through entities to get the biggest tax benefit.
At this point, does anyone have any questions that have come to mind? I'm sure there is. You can hold on to them too. So. Okay, so this is kind of the mechanics of what I was talking about earlier. It's 20% of each qualified trader business as a deduction. So if you made $1 million and it's qualified, you get a $200,000 deduction. It's then subject to 50% of the wage limitation. So if you paid out $100,000 in wages on that million, instead of that $200,000 deduction, you're limited to that 50% of wage. And the mechanics work the same with the property limitation. So if you, on that same $1 million of income, if you have only $100,000 of property, you're limited to 2.5% of $100,000. So these are the bad businesses. Health, law, accounting, actuary, performing arts, consulting, athletics, financial services, brokerage services, and my favorite part of the whole law, any trader business where the principal asset of the trader business is the reputation or skill of one or more of its employees or owners. So try not to have a good reputation. You're right. Yeah, so the first part of the law, the first draft of it had them in it. And then it removed it. But they put in that last sentence that said reputation. Yeah. So what is it? It was kind of like, yeah, architects, engineers, we're going to let you have it, but not really. So.
Well, I think the architects and engineers have better lobbyists
Yes.
than the rest of us. So we need to go out and find out who their lobbyist is and hire them.
Would that be contractors then?
No, I don't think so. But I don't know how that interpretation of reputation or skill will relate. I mean, you could really get hung on that with a lot of businesses.
So there, from our perspective, guys, there's some historical law around this grouping of professional services, and I think the question from the back is architects and engineers have historically been grouped in with what David's calling the bad businesses, but it seems as though it's really aimed at professional services.
Yeah.
So I agree. I don't think contractors would be subject to it, even those with good reputations.
Which are rare.
Yeah. Yeah, I really think this is to incentivize all other non-service businesses. And they really probably failed in trying to get that onto paper, so.
And these are part of the clarifications,
Yeah.
I think, that we all need. You know, what falls in that last bucket? I mean, how do we look at this and determine who that is?
Yeah. So questions remain. These are a few of the topics that the ASCPA has said, we need your guidance, IRS, sooner rather than later. One of them is rental real estate. Tiered entities, so how does it work when you have multiple layers of LLCs involved? What about current grouping elections, so you can kind of group like businesses together? Are they, for this purpose, all grouped together automatically? Do you have to have a new grouping? And similar businesses, are they automatically grouped? Management companies. So the other calculation in this is you have to look at this on an entity by entity basis, and then you net it together. And you could also, so if you have a loss, an overall loss in one entity, say $20,000 in year one, you get to carry that $20,000 loss forward into year two. So you basically have to break even with that one activity before you can even get this 20% deduction. So it's not quite as simple as just saying, well, this is all my income from all pass-throughs this year. So it's going to be really fun. The other big change is the limitation on losses. In prior years, we would have two limitations on whether or not you could deduct losses. It was whether or not you had money in this activity, skin in the game, and were you active or passive. Those laws are still in place, but now there's a new limitation. So you still have to check to make sure you have skin in the game, and you still have to make sure you're active in it to take the losses. But if you have more than 500,000 of losses, that gets disallowed and carried over. And it's $250 for singles. It applies at the partner S Corp shareholder level. This is one of these, it's only around for a few years as of right now. So through January 1 of 2026. It limits losses from trade or businesses that can offset wages or other sources of income. And so if you do have this loss carry forward, it carries forward to the next year as an NOL, but you still can't use 100% of that the next year. You're limited to 80%. So that's it. Does anyone have any questions now on? Yeah, you got lots of questions. We can wait till the end too.
Take a beer break and then the questions will
Yeah.
come.
Well, and you remember back when they started this whole process of tax reform and they had that press conference where they were holding up the postcards, where everybody's going to be able to file their tax return on a postcard. This 20% deduction, you're going to calculate on the back of that postcard. But that's something that I can envision a 12-page form coming out to go ahead and calculate what that deduction is actually going to be. Obviously, there's a lot of limitations. You have to look at it at each entity level. The K-1s that are going to come out from partnerships and S corporations, I think, are going to have to include a lot more information. So when it gets to the partner or shareholder level, they're going to be able to accurately calculate it on their individual returns. So I think the look of the K-1s is going to be a little bit different going forward, so we can accommodate all this information that everybody's going to have. Because you look at the limitations on the wages and property, and there's rules about when you calculate the cost of property. If it's over 10 years old, it's going to create a nightmare for us, trying to come up with what information we need to provide, what that information is, and then getting it all the way through the entity returns onto the individual returns. So again, out of the 39 things that the AICPA said we needed to have clarity on sooner rather than later, I think over half of them had to do with this 20% deduction. So it's going to be an ongoing issue that we're going to have to deal with as we get more information out of the Treasury and the IRS. So there were some international changes that came through this law. We're just kind of touched the surface on these. There are some other ones that the acronym of one of them is GILTI, G-I-L-T-I, Global Intangible Low Tax Income, and another one called FDII, which if you're an exporter can benefit you if you're a C Corp to lower the tax rate, but that's beyond what we really want to talk about here. But a couple of the things for the international side that was included in the law is 100% deduction for foreign source portion of dividends. Again, the U.S. kind of went from a worldwide tax perspective where if you were a U.S. company, depending on how you structured your foreign entities, everything was taxed here in the U.S. and you could take a foreign tax credit for income taxed in other countries. And for individuals, if you were either a resident alien or just a U.S. citizen, you were taxed on your worldwide income previously. Now we've gone to a more territorial system, which basically means we just look at what was earned here in the U.S. So as a part of that, if you've got foreign source dividends, 100% of that is deductible, again, getting back to the territorial system. And that's if you have a specified 10% owned foreign corporations by U.S. corporation shareholders. There's certain limitations to be able to take that deduction. Now, the biggest thing that you've probably all heard about is the repatriation that corporations are going to have for all this. You hear about Apple and Google that literally have billions of dollars, sitting in Ireland or down in the Caribbean somewhere. Now, with the 2017 year, as of 12/31, that income that has been sheltered offshore in other corporations is all deemed to be repatriated as of that date. So you look at Apple, they're going to have literally billions of dollars that's going to show up on their tax return this year as income. Now, what they did to kind of make a tax holiday here, which they did one of these probably about 10 years ago, which a lot of people kind of ignored. This one is mandatory. But they reduced the tax rate. As we said before, the corporate tax rate was reduced from 35% to 21%. And on this repatriated income, if it's held in cash or cash equivalents, it's a tax rate of 15.5%. And if it's in other assets, the tax rate's 8%. So if it's in intangibles or accounts receivable, anything else that isn't cash, there's a lower tax rate for that. And this resulting liability can be paid over an 8-year period, so it's not, they all have to come up with that cash right now. The funny thing about this is when you look at corporations that are going to have this, they're going to show as income all of these amounts that are going to come in, and then they're going to get a funky deduction in there based on whether it was in cash or illiquid assets to get them to that 15.5% or 8% tax rate. So it's going to look rather odd on corporate tax returns. Now, there were a lot of changes with individuals. You've probably heard about some of those. Basically, we have 7 incremental rates, the same as we had under the old tax law. You can see the old ones were 10, 15, 25, 28, 33, 35, and 39.6. We still have 7, but the top one being 37 and some of those in between, you know, we still have the low 10% rate, but some of the ones in between have been scaled down a couple of percentage points. And again, these brackets are not effective for the tax returns you're going to be filing here in the next couple of months. It's going to start with your 18 return. And the withholding tables just came out probably a week or so ago to take into account these reduced rates. So when you look at your paycheck this week, it may look like you are earning something a little more, where it's actually there's less federal withholding being taken out. And again, this is one of these that's only around for 8 years. Only through 2025 will these rates apply, and then they'll go back to the old rates. So the next few slides we've got here kind of take a comparison between the old law and the new law as far as where the breaks are and what the applicable percentages are. You can see under the old ones, sometimes there was big gaps in between some of the rates, and sometimes there were small gaps when you moved up. It seems to be that it's a little bit smoother under the new law. And again, you can see where some of these rates went from 15 to 12 and 25 to 22. But when you're married filing joint, you don't get into the top tax bracket until you get over $600,000 of taxable income, whereas previously you only had to be over $470,000. And married filing separately, they basically took the married filing joint, if you look at the tax brackets, and cut them in half. So you get up to the top, and if you have taxable income over $300,000, you're in that top tax bracket of 37%. Head of household, it's a little bit different. There you get in the top tax bracket over $500,000, and if you're single, it's $500,000 also. Some of these brackets along the side kind of follow along with the married filing separately, but then when you get up to the tax bracket, you've got a higher income limit before you get up to that top tax rate.
So Mark, what about the thing that we've all heard about, the marriage penalty, the marriage tax penalty?
Well, I'm not here to give marriage advice. And I think with a lot of it, you know, you look at the married filing separately, the single, the married filing joint. You know, if you have 2 people that are each making $500,000, you look, and here if they're married filing joint, they get up to the top tax bracket at $600,000. So you stack those 2 on top of each other, and you're going to have $400,000 that's taxed at the very top rate. Now, if they're single,
living in sin.
Well, who said? I said nothing about their living arrangement. But they're not over the top tax bracket. So it seems that, you know, you do have a little bit of penalty there for being married versus being single.
So you are saying being single?
I'm not saying anything, David. For trusts and estates, they changed the rates a little bit here, again going down, and they eliminated one rate bracket. You can kind of see it's almost as if they eliminated that 25% bracket there when you look at the income limitations for each of those. You still get up to the top tax bracket pretty quickly for trust income. You know, $12,500 isn't a whole lot of income. The Kiddie Tax, you know, if you've got children and they increased the age here a couple of years ago, that if your kids were even in college, they were subject to this. It was previously under the age of 18. But basically, under the prior law, if they had earned income, if they actually had a job and got a W-2, that income was taxed at the single rates. If they had unearned income over a certain limit, you had to look at the parents' tax returns to see what bracket they were in. So if we were doing someone's tax returns, we generally had to wait until the parents' returns were done until we could do the kids' returns, because we needed that information. Now, under the new law, the earned income is still taxed at the old single rates, but the unearned income is now taxed at the trust tax rates, basically here. So again, you know, whether the parents are in the top tax bracket, you know, they may have zero income, may have an NOL, but the kids are still going to have their unearned income taxed at these rates. And again, you get up to the top rate pretty quickly there. For capital gains tax rates, under the old law, the approach that they took was that if you were in the 10 or 15% bracket for qualified dividends or long-term capital gains, you're in the 0% bracket. If you're in the 25 through 35% brackets, you paid 15%, and you only got up to the top 20% bracket when you got up to the very top tax rate and that income breakoff. They've kind of kept that same breakoffs here. They haven't taken a look at the new tax tables as far as where the breaks are to come up with these limitations. So you do still get the benefit of the lower tax brackets at the lower income rates. For carried interest, basically these are partnership interests that are received in connection with the performance of services. You see this in a lot of private equity settings. The prior law, all you had to do was hold that 1 year and you received long-term capital gain treatment. And again, when they started talking about tax law changes, one of the things that everybody was all up in arms about is, why do these people, these incredibly rich hedge fund managers and private equity people, why do they get all of their income taxed at capital gain rates where the rest of us have to pay ordinary rates? Well, they move the needle ever so slightly with this change. They still get long-term capital gain treatment, but now they have to hold it 3 years instead of 1 year. I don't know if that's, you know, most of the private equity firms that we deal with, they're in it for more than 3 years, so I don't know if this really changes the game a whole lot. For personal exemptions, you know, under the prior law, for a married couple, they each got 2 personal exemptions and then another one for each one of the kids that they could claim. Again, that was subject to phase-outs. If your income got above about $300,000, they started chopping away at those personal exemptions until they were finally gone if your income got high enough. Now, under the tax law change, it suspends these personal exemptions for this 8-year period between 2018 and 2025. Once you get past that, they come back. The standard deductions, you know, they have basically doubled the standard deductions, which, you know, when you look at whether you're going to itemize or not, you look at your itemized deductions, and if they're greater than the standard deduction, then you take your itemized deductions. Now, we'll get into the change in the itemized deductions in just a minute, but with the increase in the standard deduction, I think a lot fewer people are going to be able to itemize because of the other limitations or changes that they made to the itemized deductions that you can take. The change in the law retains the enhanced standard deduction for the blind and elderly, and these numbers will also be indexed for inflation as we go on here. You know, with inflation being so low, the needle's not going to move very far on these on an annual basis. One of the other changes I just kind of alluded to, previously you could deduct certain expenses that you had, we call them miscellaneous itemized deductions, which included like your unreimbursed employee business expenses, your tax preparation fees, Investment fees, you know, if you have an investment account with Merrill Lynch and they charge you a fee each year, that's where these deductions would go. And if you had those deductions above 2% of your adjusted gross income, well, then they were itemized deductions. Well, under the new rule, under the new law, they've suspended these miscellaneous itemized deductions, again, for that 8-year period from 18 through 25. So again, we eliminate those deductions and less people are going to be able to itemize. The other change to itemized deductions is now that they're putting a stricter limit on the home mortgage interest deduction. Under the prior law, up through the end of 17, you could deduct interest on up to $1 million of acquisition indebtedness and $100,000 on home equity interest. Under the new law, they've dialed that back a little bit, where now you can only deduct interest on $750,000 of acquisition indebtedness. And I'm not sure where this December 15th date came in. I don't see it anywhere else and anything else in the new law, but it's a magic date that we have to follow. After that, you've got the $750,000 limit. The old $1 million limit is still grandfathered for older debt. And you can still refinance that older debt and still have that $1 million limitation. It all depends on when that original debt was taken out, and as long as it's before that December 15th date, you're okay.
So what if you take money off the table in that refinance? You not only refinance, but you had your old $1 million mortgage paid down to $800,000, and you refinance for $1 million. So I think if you take cash off the table, then that portion of it doesn't fall under the grandfather rules.
Right. And it's not just limited to your principal residence. I mean, you can have 2 residences and have that qualify. Again, you're going to have the $750,000 limitation. Now, if you had an old principal residence and say you had a $900,000 or an $800,000 mortgage on that, and you go out and buy a new second residence and say you get a $500,000 mortgage on that, well, under the new $750,000 limit, you have to reduce that by the old debt, acquisition debt, on that to determine whether you can do anything with that $750,000 limit. And again, this is one of these temporary changes that once we get back after 2025, it reverts back to the $1 million limit. Home equity indebtedness. Previously, you know, if you had a home equity loan, you could deduct the interest on it no matter what you did with the proceeds of that. For home equity indebtedness, the deduction is suspended for tax years, again, between 18 and 25. The date the home equity loan was incurred doesn't matter, so that December 15th magic date with the increase or decrease in the home mortgage interest doesn't matter. But if your second mortgage is used to substantially improve a qualified residence, it is considered to be home acquisition indebtedness and goes into that $750,000 limitation. So again, with a lot of stuff, at least with individuals, the IRS gets into tracing rules as far as what did you use the money for. And this is another indication where they're going to take a look at that home equity indebtedness and say, okay, if you took a $100,000 home equity loan and you used $50,000 of it to improve your residence, well, that's good interest. You can deduct it. That other $50,000 that you paid tuition to college, that doesn't qualify, so you can't deduct that. This is going to create more issues with us as we get past 2017 into 2018 with interest and limitations and tracing rules and all that good stuff. So you're going to get a lot more questions from us. This is one that, you know, really made a lot of headlines around the end of the year with the limitation on state and local taxes, where previously any taxes that you had from a state and local standpoint, you know, real estate taxes, whether it was on your principal residence or investment property, things like that, was deductible with no limit. You know, here in Tennessee, most people took a sales tax exemption. You could either take a sales tax deduction or state income taxes. Being here in Tennessee, most residents would take the sales tax deduction because we don't have state income tax here. Well, now with the new law in place, they have capped that deduction at $10,000. So no matter what it is, whether it's sales tax or property taxes, that's capped at $10,000. And again, that's one of these that's only in place for 8 years between 2018 and 2025. And I'm sure you probably saw in the news right around the end of the year all these people that were lining up at the tax assessor's office to pay their property taxes in 2017 to be able to get that deduction. A couple of changes with charitable contributions. Previously, when you looked at the amount of your current year deductions that you could make, you could only deduct up to 50% of your adjusted gross income in the current year. If you couldn't deduct all of it, it does carry forward for 5 years. What they've done with the new law is just increase that percentage to 60% from 50%. They also did allow you to deduct 80% of the contributions that you would make to universities for athletic seating rights. That deduction is gone now. There's also a repeal of an exception to some record-keeping rules. They also did away in this new law with a lot of the deduction for casualty losses. So under the previous law, if you had some losses arising from fire, storm, I've never seen one from a shipwreck before, but I think there must have been a lot of those, and that's why they changed the law. Or other casualties, or if you had a theft, if somebody broke into your house and stole a bunch of stuff and you didn't get an insurance reimbursement. Now under the new law, you can only deduct these if it's in a federally declared disaster area. So if your own personal residence burns down and you're not in the middle of California where there's a huge wildfire or something like that, any loss that you have on that is no longer deductible, again, for this magic 8-year period. The medical expense deduction, they actually changed a couple of years ago to increase the floor to 10% of your AGI for us young folks that are under the age of 65. They still kept it for those 65 or older. Now what they've done is just go ahead and reduce it to 7.5% for everybody. The amount that you were able to deduct previously was an adjustment when you calculated your alternative minimum taxable income. That's gone now. And again, that's for the just a couple of years here for 18. Previously, and I think this goes back to one of the Bush presidencies where, you know, the read my lips, no new taxes, but we're going to put in limitations to phase out your itemized deductions and phase out your personal exemptions. And this was called the Peace limitation previously, not Peace, but a guy in Congress named Peace, where if your income got above about $300,000, your AGI, any dollar that you went above that, they started limiting your itemized deductions by 3% of that amount. Well, that limitation is gone now. So if you've got itemized deductions, you get 100% of those if you actually can itemize and don't take the standard deduction. Again, this is one of those that's suspended for this 8-year period. Once we get past 2025, it'll come back. Now, as Jerry mentioned before, for corporations, they did away with the alternative minimum tax, and I think they really wanted to on the individual side. Why they didn't, I don't know. But what they did do is they increased the exemption. Previously, under the old law, the exemption for married filing joint was, what, around $55,000, $57,000, something like that. They kind of doubled that for all taxpayers. And previously, your exemption for AMT purposes was phased out when your income got above $300,000. Now they've moved the needle on that up to $1 million for married filing joint and $500,000 for single or married filing separately. And one other thing, if we go back a couple of slides and you think back to the state and local tax deduction, that's limited to $10,000 now. Not to get too far off the path and into the weeds, but when you calculate your alternative minimum taxable income, those taxes are one of the things that would get added back when you calculate your alternative minimum tax. Well, now those are limited to $10,000, so that's going to limit the add back. So I think we're going to see a lot fewer taxpayers that are actually subject to alternative minimum tax, which is a good thing. I mean, this was put into the law back, I think, in the 60s when 3 millionaires ended up not paying tax some years, and Congress got all pissed off, and they put this into effect, and we've been having to deal with it since. And again, this is one of these provisions that's just out of the law for 8 years. Once we get past 2025, it'll come back. Again, I'm not here to give marriage advice, but there's a big change coming up after this year, so it starts in 2019. Previously and up through 18, any alimony payments that are generally allowed as an above-the-line deduction for the payor and included in the income of the recipient. It could be excluded, if it was designated as such in the decree, but generally, whoever paid it got a deduction, whoever received it picked it up as income.
And you'd expect that the payor in history would be in the higher tax rate.
Generally in the higher tax bracket.
Be in the lower tax rate. So.
But now under this law, you don't get a deduction if you pay it, and if you receive it, it doesn't get added into income. So this is effective for divorce decree, separation agreements, and certain modifications that are entered into after 2018. So divorce lawyers, I think, are going to be kind of busy, especially towards the end of the year, trying to get these things done.
Well, you told them to because you wanted people to be single. Isn't that what?
Told you I'm not here to give marriage advice. Still think the single brackets would overcome this, but effectively what this does is it taxes the alimony that previously would have been taxed at lower rates in the higher rates of the payor.
Yeah. Now the child tax credit, this is one thing that was put into the law, I think, that somewhat offset, the loss of personal exemptions. If you're a married couple and had 6 kids, you had 8 exemptions at $4,000 apiece, so you lost $32,000 of exemptions, of deductions. But what they've done with the child tax credit now is basically double it from $1,000 to $2,000, and they've increased the phase out where you actually lose that credit. And that's what we find out with a lot of our clients under the old law, is that they were above the income limitation, so they would lose the credit. Now the phase out, which was previously $75,000 for single and $110 for married filing joint, now it's up to $200 for single and $400 for married filing joint. So I think a lot of people are going to be eligible to go ahead and take this credit, whereas previously a lot were phased out. And now that my kids are all off on their own to college, I lose this. And again, this is one of these changes that has that magic 8-year freshness date on it, and after 2025, it'll revert back to the old $1,000 credit. Moving expense deductions. Under the prior law, if you moved within a certain distance and had a new job in a new city over 39 out of the next 52 weeks, you could deduct your moving expenses. Now, under the new law, basically it suspends that deduction for that 8-year period. It's generally still deductive for active service military members that have a permanent change in station, which is a good thing. Educational savings, they kind of sweeten this a little bit, where you can actually use $10,000 per year for elementary and secondary schools, whereas previously it had to be used for post-secondary education. And again, this one is after 18 and does not have an expiration date. There's a change in the law on discharge of indebtedness for student loans. Previously, any student loan that was forgiven was considered to be income, even if it was on account of death or total disability. Now there's an exclusion in there that if the discharge is because of death or complete disability, that it's not considered taxable income. And that, again, is effective starting in 2018 here. Kind of in tandem with the exclusion or the no longer deductibility of moving expenses, previously employers were able to reimburse employees on a tax-free basis for their moving expenses. Since the moving expense deduction was put on hold, now the reimbursement of those expenses by an employer now is going to be considered to be taxable, whereas previously they could be reimbursed and not be taxed to the employee. This one is suspended between 2018 and 2025, and the exclusion is, like with the moving expense deduction, still there for active duty members of the armed forces. Now, one of the things that has been talked about through trying to get rid of the Affordable Care Act and things like that, one thing that they did do in this law, and if you think about the date that the law was passed, it was December 22nd when it was finally signed by the President and effective. Now, if you were signing up for your health insurance through the exchanges, you had to sign up between November 1st and December 15th. So everybody had been through all that. So I think they didn't want to kind of make people mad that they just had people sign up for insurance and now said, oh, forget about it, you don't have to now. So this is not effective until actually after 2018. So 2019, they've done away with the individual mandate that previously basically said if you don't have insurance that has a minimum essential coverage, that you're going to be penalized for each month that you don't have it. Now, there were a few changes to the estate laws. Basically what they went ahead and did was double the exclusion amount. Previously it was a little over $5 million, about $5.5 million, and now they've basically doubled that up to, they expect it to be $11.2 million with the adjustment for inflation in 2018. And it's effective for decedents dying and gifts made after 2017 and before 2026, so again that 8-year period. And this includes not only estates, but also gifts that are made during that time period. They did the same thing with the generation skipping tax. Basically what this is they don't want people going ahead and making gifts or leaving assets to their grandchildren, so those assets skip the generation of their children and get out of paying the estate tax if it's applicable. So basically what they have is put in another layer of tax on top of the estate and gift tax if you gift things or leave money to somebody past one generation down. And basically what they've done here is to keep that limitation the same as the estate and gift tax limitation and double it to the $11.2 million. And again, that's effective for transfers starting in 18 and through 2025. A couple of other small changes here. Change in the law regarding the recharacterization of certain IRAs and Roth IRA contributions, where previously people would change the characterization of IRAs back from regular and Roth. That's no longer available. You can't. Other recharacterizations are still allowed, like a contribution to a traditional IRA as a Roth IRA, and vice versa is still allowed. And the deadline for recharacterization is still generally the extended due date of your individual returns. There's a little extension of the time for people who took plan loans, may have severed their employment with an employer. Previously, you could go ahead and make a contribution to an IRA, so then that plan loan wouldn't become taxable to you. Previously, you had to do that within 60 days. Now you have up until the due date of your return to go ahead and do that, which may be up to a year, just giving you additional time to do that. There is also a little sweetening of eligibility for qualified equity grants for startup companies, make it a little bit easier and a little less cost prohibitive to give those to employees. So that's it. I'm sure there are questions, and Jerry will answer all of them.